We are now seeing volatility rise in the treasury markets. This GTV chart on the Bloomberg just showing how that volatility has even surpassed that of equity markets. How do you position in this environment?
So for the bond market, it has been quite a volatile time. We have seen volatility in both credit markets as well as in rates market spiking up over the past couple of months, despite very low yields generally. So for us, we are still looking at the market with a central scenario where growth can stay positive, albeit we'll be entering into a window of weakness. So that means U.S. growth will be slowing down into closer to 1% over the next 6 to 9 months. And closer to home in China, we also expect growth to also slow, and that the policymakers will not actually be aggressively pursuing stimulus as they might have in the past 10 years. So this is sort of the backdrop where we want to position ourselves to look for kind of lower rates, perhaps coming out from some of the Asian markets, in particular China, where we'd expect rates to gradually come down, especially given the central bank has tried to improve the transmission mechanism with more market-based rate, and that might percolate into the broader bond market there.
We have experienced some global credit markets performance since 2016 seeing a great uptick. Is this expected to continue, and how does it affect the risks over credit quality?
Well, I think the issuance certainly has picked up a lot, globally and also in Asia. We are likely looking into a year again of record issuance from an Asia dollar credit standpoint. Now, this year in particular, we have seen a lot of high-yield issuance being done in the first half of this year, albeit we expect the second half to slow somewhat because, particularly from China, there will be certain quotas that would come into play, meaning that it would limit some of the issuers from coming, in particular the Chinese property sector. So from the supply standpoint, the first half, we have seen a lot of inflow that have absorbed those kind of supply, and with the second half being the supply being a little bit less, we think the market can still absorb and digest those new issues.
You have a house view, though, don't you, that's cautious on corporate credit risks. So where do you see those risks building the most?
Well, in the U.S. in particular, we'll be underweight the generic credit. So credit beta, if we look at it from an index standpoint, the index is expensive, relative to historical valuation. And however, we see a lot of individual opportunities coming up, especially with volatility. There are new issues that are coming out that could offer quite decent concession. In particular, in Asia, if I look at the investment grade, that would be more of a generic beta that is closer to the U.S. And the spread of Asia investment grade would be roughly in line with the historical average with the U.S. So there, we haven't kind of identified too many opportunities. But in the high yield space, the spread has stayed wide to U.S. high yield equivalents, meaning that the spread of Asia high yield now by an index level is about 180 basis points or so above the U.S. high yield. So from both a carry standpoint and also from individual issuer picking standpoint, we actually identified quite a number of interesting plays that we have put into our portfolio.
How about a duration standpoint, though? Because do you see this decent yield in emerging markets over developed markets persisting for some time?
Yeah, we think in terms of duration, what we have from a firm standpoint have favored some of the U.S. Duration side, because it still have some room, to go compared to Japan and European yields, which are already yielding in negative territory. From an Asia standpoint, we also see scope for that to come down. China, which I mentioned slightly earlier, we see scope for some rate cuts to come through. They haven't really done much from that standpoint. So with that improvement of the transmission mechanism, afterwards we see rate cuts over the next 9 months via kind of new loan prime rate and the medium term facilities there. Other parts of Asia has also been lagging in terms of the rally compared to the global developer bond market. We also see some of that to have scope to come down, especially when inflation has been quite benign.